something that is very interesting to me is that in order to get the level of success you want to get, you have to be obsessed with your craft. Meaning, it makes it a whole lot easier to find like minded people. Because if you look for the people that are already successful after you've made your success, or the people who are achieving things, you're able to get on the same frequency as them, understanding that since they're achieving something, there has to be a level of obsession, a level of drive that's on par with yours. I don't know, it's just something that came to mind. Now, let's get into the charts today. This video is titled, what am I going to title it? Trade reflection, how to avoid meaningless losses. This is a very, very, very valuable trading reflection. I didn't take any trades. I just title it trading reflection because I don't like titling it trade recap because everybody puts trade recap. I don't want to be like everybody else. But trade reflection is just on the day, whether I take trades or not. So enjoy. I hope you're able to take value from this. Let's get into it. Yesterday, the day prior, I had made another note. If I go right here, bam, avoiding unnecessary losses within price action. Let me just move this to the side. Avoiding unnecessary losses within price action. This is 50-50 market conditions. What are 50-50 market conditions? Well, if I were to break it down very, very simply, it's when you have a mixed bias. When would you have a mixed bias? And why did I do this note? If you guys want to watch the YouTube video, this is the link right here.
I have a question.
This is the video. It is from Ario. He is an amazing mentor, so check his stuff out. His stuff is a lot more advanced, but that's why I'm here to break it down for you guys. I'm kind of like the mediator. I break it down more simply than Ario, even though Ario's great. Anyway, so during times like this, I refer to it as almost forgetting how to trade. You can see what I wrote right here. This is referring to the days where we feel almost as if we forgot how to trade, taking loss after loss, having no understanding or idea on where or what the market is trying to do. For me personally, I would consider these days confused bias days, better yet known as 50-50 trading days in the terms of probability. Now, when you watch a YouTube video, any YouTube video as a whole, you take notes on the video. That doesn't mean you strip the entire video script and put it into your notes. You personalize your notes to you. So, going into this, what was I emphasizing? Well, I was emphasizing trying to understand how to avoid improbable price action. Let's break down the note a little more because it will go fully into today, I promise you. These note sections are more important than the trade recaps or the day recaps. The day recaps take a minute to do. Emphasize the boring stuff I'm telling you right now. Anyway, so continuing with it. There's DXY correlation, but let's skip past that for a minute. So, right here. The question, what is the conditions we are speaking of when we say 50-50 price action? Because that's important. Some of you guys may be like, well, 50-50 price action, yeah, improbable price action. What's improbable price action? Having two PD arrays within the opposite direction, i.e., for example, price action retracing into a bearish daily fair value gap PD array as well as being within a bullish 4-hour fair value gap PD array. Let me showcase to you guys the image I'm speaking of. Because I'm a visual learner, I have to see visually. So right here we see price action made a retracement for this daily PD array. Bam, began to validate it. However, with being within this daily PD array, or also within another daily PD array, creating a conflict between price action, just like this. So we have price action retracing here, price action retracing here. Just call it there. And let's say this example, we had an imbalance here and an imbalance here. It creates a conflict within this range. Makes sense? Not yet. We'll keep going into it. Anyway, Breaking this down, we understand it makes a conflict within price action. Now, you could pause and read if you want. I will link this in the description below so you can go in and look at it yourself and read all the notes I took. But now, there is a way to take advantage of improbable price action. You just have to understand that it will require a lot more patience. A lot more patience. You have to be patient with it, because if you're not patient with it, you will get caught in something like today. Today, what happened? Well, price action showcased improbability. How did we know this? How did Lonnie open the charts just understand price action would be more improbable today compared to, let's say, yesterday? Because the PD array retracement. Now, I'll go into that in a second. Let's go back to the notes. I'm not trying to take you guys too far. I'm trying to stay on track. So, very important. Low probability conditions often feel like they last forever. That's important to know. Low probability conditions consolidate more, have more ranges, take forever to take people out of the market, compared to high probability conditions where if you blink, you miss it a lot of the time. Think of your best A+ setups. Think of your best setups. I'm sure, however you may execute, when you see there's A+ market conditions, you don't steer away from the chart. You don't allow yourself to get distracted, because why? You know, if you look away for even a second and price action makes that quick retracement, it's doing whatever it's doing, meaning you'd miss your setup. You don't want to miss your setup because you know you're in high probability market conditions, because price action is not sitting there consolidating, conflicting within bias, or conflicting your bias. Anyway, so right here we see identify the 50-50 area. This is how you avoid low probability conditions and or take advantage of them. Identify the 50-50 area. This area is usually the consolidation range. Simply put, look at images below or the YouTube video for reference. I will show you the images I put. A close above the range, showcasing a change in order flow. Simply put, the displacement out of the range. This is very important because it showcases the completion of the transition of order flow. What does Lonnie mean by this? Well, let's go here. Where's it? Path. Bam, 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 bam. And let's say we see a strong move back to the upside. Right here, we have an imbalance. Say we have a macro time frame imbalance, whatever. However, right here, we also have imbalance. This full change of character, per call it whatever you want, right up here. I don't know why it's drawing like that. Right up here showcases the full transition within price action. However, the question is, Lonnie, how do we take advantage of this move up? Because we don't just want to miss this move. So there has to be a way we could take advantage of it. There is, however, it's a lot more risky. So you have to approach it with adequate risk management, because you understand that you're trading within lower probability market conditions. Market conditions even out again to high probability once we get out of this range. Don't confuse it. So, going back to the notes, identify a fair value gap or P array, choose whatever P array you want, above or below, change of character. So if price action would have broken lower, right here, identify any PD array you utilize in order to get into the move. Same thing vice versa to the upside. I will showcase chart examples. I know it makes more sense when you see it on the chart. I'm just trying to explain it, because when I explain it and you rewatch this video, you will understand fully. Now, going back to the notes right here. This is a very, very good image. We have a bullish 4-hour fair value gap PD array, and we have a bearish 4-hour fair value gap PD array. Currently, we're doing what? We're conflicting within both of these, consolidating. This right here is the low probability area. This is where you don't want to be trading. Now, you may be like, well, Lonnie, this is common sense. It is, but so many people miss it. Even me. I've been missing this for a year and a half until now. I didn't understand this till yesterday. And then today, actually applying it. This is the low probability area. Now, a lot of the times, we may sit there and justify it and say, oh, well, scale down on the lower time frame. This is a clear setup right here. The main aspect is where price action is expanding toward. We want to take advantage of the actual move. We don't want to sit there in consolidation, waiting and crossing our fingers, hoping for price action to play out within our favor. We want our moves to always be within higher probability compared to low probability areas. So right here, we see this is the low probability area. This is the displacement, just like in the example I showcased, drawing it out. This is the displacement, the change of character, call it whatever you want, out of this low probability area. The breakout of low probability area. I wrote it weird. Breakout of low probability area, also known as this is the 50-50 area. So we're identifying the 50-50 area. Now, this showcases, what does this showcase? Because this has to have meaning, right? This showcases that we will no longer validate this bearish 4-hour PD array and instead begin to validate this bullish 4-hour PD array. Now, you can utilize whatever other confluences. We see price action swept out these lows. Bam, displaced for the upside. All that good stuff, right? Whatever you want to call it. Now, upon this, we see a 15-minute fair value gap PD array form. This is a very high probability setup. Why? Because now we've broken out of that low probability area. We see that we began to validate, and we're beginning to validate this bullish 4-hour PD array following within trend or within the direction where price action is currently looking to trend toward, meaning we could take advantage of this move right here, getting in at the fair value gap, whatever the case is, however you get into trade positions, right? So you could pause and read. Go look at the link in the description. I fully explain the entire thing and or watch the video. I apologize for not going fully into depth of this topic. If I did, the video would be 20 minutes long. I don't want it to be so long, but I'll finish with this. This is probably the most important segment of this video right here. Emphasize this and listen to this. Trading requires a lot of patience. The highest probability price action does not happen within 50-50 scenarios. We understand this. Many traders are unable to ever get to trade the high probability conditions because, due to having taken so many losses within the low probability market conditions, either destroying their trading psychology or liquidating their trading capital, it negatively affects them going into the next trade. You have to realize, taking these losses, if you're not prone to taking them, right, if you're not focusing on the process, it will negatively affect your trading psychology. This is why I can take 8 losses in a row and continue to keep trading, not having it destroy my psychology, because I've had worse losing streaks than this. Yeah. So, and I've been in the game for a while. But this is mainly because I understand my probability and I understand when I'm executing in higher probability compared to lower probability, and what my emphasis is, which is on the process of understanding how to execute in higher probable market conditions compared to lower probability market conditions. So when I take losses, I don't view them as losses, I view them as learning opportunities. Remember that. Now, going into the important note, Ario said this himself. I stole this quote from Ario. Trading is it's not so much about winning as it is about avoiding to lose, avoiding losses. Winning is not the hard part of trading. It is very easy to click a button on the chart, sit in hopes and cross your fingers that the outcome will be 50-50. You will either win or lose. A lot of traders, between the winning trades, do not know how to stay out of the market. Simply put, it is easy to win, so don't think you're rewarded by a win. You're not. It is so easy to win within these markets. You know what's truly difficult? Knowing when to stay out of the markets and avoid improbable, improbable trading days, maintaining and retaining those wins and the profits you make from those wins. Understand? Good. And I wrote it right here. Staying in the market and staying out of the market go hand in hand. This relates to a trader's level of patience. How do you know how patient you are within the markets? How do you know how patient of a trader you are? How you'll actually find success within this industry? It's equivalated to how patient you are, or it's equivocal to how patient you are within trading. How long are you willing to wait for your probable market conditions? And this doesn't mean wait like 2 years, obviously, because we're about to go in and see how do we take advantage of 50-50 market conditions, because you can, and I'll show you how. So here you go, because it's very simple. This is the actual day recap. Price action was bullish to the upside. Cool. Going on the daily time frame, we see that yesterday we crossed above all-time highs, like we didn't say it, I said it. I'm joking. Like we said we would. Bam, price action crossed above all-time highs. Cool, but that's not the main point I'm trying to emphasize here. Some people will call it a liquidity sweep. Some people will call it a liquidity run. We're going to continue to the upside, whatever the case is. I don't care what you call it or say. This is the most important part. Me, when opening the chart, originally, when looking at the 4-hour, I was like, we're bullish. We're continuing to the upside today. We made a 4-hour bullish for value gap retracement. A lot of people would say this. Now, what made me emphasize and realize this was 50-50 price action? Well, we had this 4-hour PD array right here. However, if you look closely, we also had this 1-hour bearish PD array. So what did this create? Improbable price action. Why? Because within this range right here, we created a conflict. Price action right now is doing this. Some people may scale down on the lower time frames and be like, wow, price action looks amazing today, because it does. Price action on the lower time frames looks nice, but that doesn't mean it's probable to trade. If you would have traded today, you either got lucky and gambled, or you got stopped out. There's no if, ands, or buts about it. So let's get into it. Right here, we have a conflict in price action. Now the question becomes, how do we know which one will be validated and which one won't? You don't. You don't know. You don't know. You don't. And you don't know unless you wait. This is why trade patience is so important, and you have to understand where to wait. Now, this entire range from this 15-minute high to this 15-minute low, as well as the hourly range, everything in between it is the 50-50 range. That is the 50-50 range. Remember, it's a range from this high to this low. Why is it from that high to that low? And if you made it to this part of the video, congratulations. Why? Because from this high to this low is where we've seen the retracement into this 4-hour imbalance, as well as the creation of the conflicting PD array. That's why this is the range. So you may be like, well, Lonnie, if price action would have rallied today, how would you have taken advantage? Well, it went to the 15-minute and waited for the 15-minute range to be either closed above or below. You could see I have both marked out. The 15-minute ranges, the hourly ranges is slight extreme, because 15-minute can definitely showcase that change of character. This is the advantage of scaling down within time frames. However, you don't want to get trapped. This is the one thing. You don't want to get trapped. Next thing I'm going to go in and study is seek and destroy market conditions. But I would assume these are seek and destroy market conditions where we're just consolidating. Everybody puts a fancy name on everything. Anyway, Right here we have the 15-minute ranges. When would Lonnie have looked to trade it today? Well, if we would have closed above or below these ranges, because it would have showcased the validation of this 4-hour fair value gap. Does it make sense? This 4-hour PD array. In simple terms, in 5th grade terms, because I always like to say it, I'm not gonna write it out, that takes too long. The closure above or below a range is what showcases the validation of either or of the PD arrays you're using. Let me dumb it down even more. In order to see which fair value gap will get validated, you wait to see which one gets respected. Well, Lonnie, that's obviously you have to wait to see which one gets respected. No. Wait and see which side you change trend to. I can put it into words. Let me put it into words, because if you can't explain it in detail, then you don't understand what you're saying. If I truly understand this, I should be able to fully break it down on video. How are we able to understand which PD array will get validated? We are able to understand which PD array will get validated based upon whether or not price action closes above or below a range. Simply put, anything within this range is known as 50-50 price action or improbable price action. Does that make sense? PD array here, PD array here. Everything within here, everything within that range is improbable price action. We are trying to avoid that. How do we avoid that? By waiting for us to close either above or below the range, showcasing a validation of either or of the PD arrays we have conflicting. Meaning, if we were to validate this hourly bearish PD array, what would we do? We would displace to the downside on the 15-minute. We would break out of this range. Make sense? If we were to validate this 4-hour bullish PD array, what would we do? We would break out of this 15-minute range to the upside. Wow, I'm good at explaining things. If you're not able to explain it, you don't know what you're teaching. That's true. So there you go. That just simply put, let's showcase another example. Perfect, right here. Bam. 15-minute, 15-minute. We have conflict within here. Well, you may be like, well, Lonnie, how do you know we have conflict? You don't see anything. We just blew past it on the 15-minute. We go to the 5-minute, and we go to the 1-minute. We're able to scale down and see. So, oops. So right here. Actually, this is too messy. Let's mark the other far imbalance below it, because what the heck? Or other 15 minutes, sorry. 1 second, students. Bam. Same thing. Anyway. How do we know we won't validate this bearish PD array instead of this bullish one? Well, we scale down. What happens on the 5-minute? Well, guess what? Guess what, little Diddleson? Where is the range? The range, well, on the 1-minute time frame, we could also look at the 5-minute, is from here. I can't move my chart. To here. This is the range. So everything within here is improbable price action. Everything within this range. So what does this mean? Does it just mean we sit there and sit on our hands and wait? Or is there a way we could take advantage of it? Well, let's see. If we scale down in time frame, we see the validation of this 4-hour imbalance. This is the tricky part, and this is why I won't do this. You can definitely catch these moves, but you have to understand it's your probability. The probability is not within your favor. If you do catch moves like this, you have to make sure the duration of the trade is short. You're not trying to catch a whole expansion because you understand there could be conflict within this range right here. I can't move my chart down. Within this range right here. Right? So your focus during times like these is to catch quicker moves. More so getting in and out of the market, either intraday moves or scalp moves. Because you understand that the probability isn't fully within your favor. Now you can stack probabilities and you can do that too. But if we're just playing it from the safe side, meaning not going crazy into depth and confusing you all, our focus is to wait until the breakout of the range to showcase clear price action. Here you see, once we did, we continued expanding to the upside, right? Of course, the move started down here. However, this entire range was lower probability. So, you could have traded within this, but you would have had to mitigate your risk. You would have to been more cautious and have to have waited for clearer confluence, the clearest confluence, in order to get an execution. And you would have had to wait a whole lot longer for an expansion compared to, well, probably here. If I skip forward. I'm on EST time. This is London and Asian. Hold up. When does New York open? There you go. And now you may just be like, well, that's just because of New York session. No, it's not just because of New York session volatility. This is also because you're no longer within a range. You have to stack the confluences together. So, what do we have? Why is price action able to, move faster toward our draw liquidity? Because right now we're in New York session, but guess what? Price action is just consolidating, right? So it's subjective for you to sit there and say, oh, well, price action started, rallied, continued to the upside there because New York market open. Well, New York market open today and we're consolidating, right? So it's subjective. Don't just call it to that. Don't allow your ignorance or your arrogance to sit there and blind you to the fact of what just happened. Even right here, we were within a range. If I showcase it, it's smaller, but you can see it because this is fractal. Bam. Bam. Right here. Wow, how do you know it's fractal? Let's go on the 1 minute time frame. What were we doing? We were consolidating on the 1 minute. This is fully fractal. This is the full breakout range. This is the change of character. This is the full breakout range, although you could take advantage of this too. But this is where I would look for a trade entry. Unless I want to mitigate my risk and look for one after we break above here. This is the range. Meaning if 1 minute would have, bam, broken to the downside, we would have liquidated to the downside. And guess what? New York market open, we would have pushed lower. Same thing vice versa. What do? We push to the upside, displaced, then showcasing what? That strong confluence of us continuing to the upside New York market open. Right? And just so you guys aren't like, oh, look at New York market open right now. This is perfect proof. These 50-50 price action ranges can happen within any session. It's not about the session. It's not about, oh, New York volatility, you're able to take profit faster. No. If you're within a trade right now, you'd still be within your trade. Why? Because of the probability of price action. You're within 50-50 price action. This video was a whole lot. It was very surface level. I didn't get into it as much, but I hope you all were able to understand. If you actually want to fully go in and learn it, comment below. I'll make a full video on it. If you made it till the end, comment Diddy. I'll know you made it till the end. And if you comment Diddy, I'll make a full video fully explaining this. This would be a headache to make, but I did explain it, and I did showcase examples. It's a pretty simple concept to understand, but it's confusing. But if you do this, you will avoid taking meaningless losses, like if you would have traded today, right? If you would have been like, oh, okay, cool, we broke structure to the upside on the 5-minute. Let's go in, let's execute a long position, stops below this low, let's target the high. You'd still be sitting in consolidation 2 hours after market open. You don't want that, right? So doing this helps you avoid taking meaningless losses. That's why focus on the higher probability price action. And how do you trade the lower probability price action? You wait until breakout of the range, the 50-50 range, in order to showcase to you where you will go, having it then become higher probability price action. It's as simple as that. Obviously, it's not as if you were just following daily trend and all that, multiple time frame confluence. No. It's just a breakout of the 50-50 range. You're able to take advantage of. Don't hold your trades for too long unless you're sure that it's biased, changing trend, continuing to follow in a higher time frame narrative. But if you're just catching a quick intraday move, target your quick draws liquidity. Don't have the duration of your trades be too long, because price action can make that move within your favor and then quickly reverse, or same thing vice versa, right? So now I gotta upload this video. But yeah, so there's a recap on the day. No trades. This was a lesson rather than a trade reflection. So I hope you guys enjoyed. Download link, or not download link, view link will be in the description below.